Now after completion of liquidity ratio, solvency ratio and turnover ratio, 3 we have completed. Now fourth ratio is profitability ratio. Profitability ratio. Profitability ratio, through this ratio we try to judge the efficiency of the business, because everything depend upon the profit of a business. How much capital we have invested, and in comparison to capital or in relation to capital, how much amount of profit we have earned. How much amount of profit we have earned. Entire things finally comes to profit. If the profit is sufficient or higher, then this indicates the business is operated very efficiently. Management efficiency indicate whether management is efficient or not efficient. It totally depends upon the profit. How much profit the business has earned. This is very important. So under the profitability ratio, we will see these ratio: gross profit ratio, operating ratio, net profit ratio, operating profit ratio, return on investment, return on equity, PE ratio, price earning ratio. There are so many ratios we calculate under the profitability ratio. Earning price per share, okay, earning price, EPS, earning price per share. But here in our syllabus we will see that these 5 ratios under the profitability ratio: gross profit ratio, operating ratio, operating profit ratio, net profit ratio and return on investment, that is ROI. So profitability ratio, main objective of every business to earn what? Main objective of every business to earn profit. Profit is the main objective. A business must be able to earn adequate profit in relation to the capital investment. In relation to the capital investment, as compared to capital, how much amount of profit the business has earned. In relation to capital, in relation to turnover, means sales. Okay. So the efficiency and success of a business can be measured with the help of these ratio. Efficiency of the business can be measured with the help of these profitability ratio: gross profit ratio, operating profit ratio, operating ratio, net profit ratio, return on investment, return on equity, EPS, PE ratio, price earning ratio. There are so many ratios. Okay. So first of all, we will see the gross profit ratio. Gross profit ratio, simple formula is gross profit upon net sales. Net sales means revenue from operation. Net revenue from operation into 100. This will indicate in terms of percentage, expressed in terms of percentage. Okay. Now we'll see one problem related to gross profit ratio. One problem related to gross profit ratio. Now see one question based on gross profit ratio. From the following figure pertaining to two companies, company A and company B Limited, belonging to a plastic industry, calculate the gross profit ratio of two companies. Which company is doing better? So company A and company B, information related to company A and company B is given in the question. Information are net profit after interest, operating expenses, interest on debenture, revenue from operation, gross sales, and revenue from operation return, that is sales return. So from gross revenue we will deduct the sales return, then we will get the revenue from operation net revenue from operation. So company A and company B, company A limited company, and company B limited information is given. Okay, company B limited. So gross revenue in this question, revenue from operation gross is given. Gross means gross sales. Gross has given revenue from operation gross is, that is the gross sales is, company A limited is 3 lakhs, company B limited is 3 lakh 80. A limited gross sales is 3 lakh 30 and company B limited is 3 lakh 80. You deduct the sales return. Revenue from operation return means it's a sales return. You deduct it. Sales return is 10,000. One company, another company sales return is 20,000. So it's a 3,20,000. After deduction 3,20,000 and 3,60,000. This is what? This is net revenue from operation. Net revenue from operation. Okay, first we have find it out, net revenue from operation. So here in this case we will calculate the gross profit ratio of both the company A and company B. Now next information is interest after, net profit after interest is given, and we have to know the gross profit, not net profit. So what we will do to find out the gross profit, you know how to calculate the gross profit? Net sales minus cost of goods sold is the gross profit. Net sales minus cost of goods sold. What is cost of goods sold? Opening inventory plus net purchase plus direct expense minus closing inventory is called cost of goods sold. When cost of goods sold compare with the net sales and net sale exceed the cost of goods sold, it's a gross profit. Okay, gross profit. So gross profit is equal to your net profit given, net profit after interest has given. So you add the interest, on debenture, number one. Number two, you add the operating expenses. Operating means office and administrative, selling and distribution expense is called operating expenses. Office and administrative and selling and distribution expenses are called operating expenses. So when we add in the net profit after interest, it is given after interest. In this we add the interest, then it is net profit before interest plus operating expenses, then it's a gross profit. So gross profit of A limited. First of all, we'll calculate the gross profit of A limited. A limited net profit after interest is 75 plus 15,000 is the interest on debenture plus operating expenses is 10,000. Okay, 10,000. So it's a 1 lakh is the gross profit. Company B limited gross profit is, net profit after interest is 1,10,000 plus interest on debenture is 25 plus operating expenses is 15. So it is 40 plus 1,10,000, it is 1,50,000. 1,50,000. Okay. Now we will find out the gross profit ratio of both the company. Gross profit ratio of both company. Okay. So first of all, we will find out the gross profit ratio, GP ratio of A limited. Suppose A limited, GP ratio of A limited. GP ratio means gross profit ratio of A Limited. So gross profit is 1 lakh and revenue from operation is 3,20,000 into 100 into 100. So 1 lakh upon 3,20,000 into 100. So 40 cancelled. Okay, it is 16, it is 5, it is 8, 50, it is 4, then it is 25. So 125 upon 4. So 31.525%. 31.25%. This is the gross profit ratio of A Limited. Now we'll calculate the gross profit ratio of B Limited. Okay, so gross profit ratio of B Limited is, gross profit is 1,50,000 and net sales is 3,60,000 into 100. So 40 cancel. Okay, 3, 2, okay, 4, 3, 25, 125 upon 3. So it is 4, 1, 6, 7, 41.67, 41.67. It means B Limited company is better than A Limited company, whereas the gross profit ratio is concerned. A Limited company gross profit ratio is 31.25, whereas the B Limited company have a gross profit of 41.67. So B Limited company is better than A Limited company because the B Limited company have a higher gross profit ratio as compared to A Limited company. Okay, so B Limited is operating much better, mean in an efficient manner in comparison to A Limited. Okay, now see the next question of gross profit related to gross profit ratio. So question is, calculate the gross profit ratio from the following informations. Credit revenue from operation is given, that is 3 lakhs. Cash revenue from operation, in bracket it has mentioned, being 25% of total revenue from operation. It means cash revenue from operation is 25% of total revenue from operation. Information of purchase is given 3,30,000 and excess of closing inventory over opening inventory is given. Closing inventory, excess of closing over opening is 40,000. Now, so we have to find out the gross profit ratio. So first you write the formula of gross profit ratio. So gross profit upon revenue from operation into 100. Revenue from operation means net revenue from operation after deducting sales return. So here credit revenue is given, 3 lakh is the credit revenue and cash revenue is 25% of total revenue. Suppose total revenue is 100. So as per this information, cash revenue is 25% of total revenue. So cash revenue means cash revenue from, you can say cash revenue from operation. Okay, that is called cash sales. You may say it is cash sales is 25% 25% of total revenue. 25% of total revenue. So total revenue, if I assume 100, it means cash revenue from operation is 25 rupees. So total revenue minus cash revenue indicate what? Indicate the credit revenue. Indicate what? It indicate the credit revenue from operation. Okay, credit revenue from operation. In this question, credit revenue from operation is given. So you do the link with this. When the credit revenue from operation is 75, so total revenue is 100. So on the basis of that, revenue from operation will be revenue from operation is equal to, when credit revenue is 75, total revenue is how much? It is 75, so total revenue is 1. When credit revenue is 1, then it is 100 by 75. And when the credit revenue from operation is 3 lakhs, then it is 100 upon 75 into 3 lakhs. Yes? So here you write 100 upon 75. 100 upon 75 into 3 lakhs. So you will get the information of revenue from operations by applying this one. So here 3, 4, it is 1 lakh. So 4 lakhs is your revenue from operation. So in this formula, revenue from operation is 4 lakhs. Okay, revenue from operation is 4 lakhs. Now, next information is given what? Next information is, we have to find out the gross profit ratio, gross profit, but gross profit is not given. We know the gross profit is equal to revenue from operation, minus cost of revenue from operation, cost of revenue from operation means cost of goods sold, you can say. Cost of revenue from operation means cost of goods sold. So revenue from operation, we know that is 4 lakhs. Now we have to find out the cost of revenue from operation from the information given here. Cost of revenue from operation, we know that cost of revenue from operation is equal to revenue from operation is equal to opening inventory plus purchase plus direct expense, but here no direct expense is given, so leave it, minus closing inventory as per the information. Opening inventory plus net purchase plus direct expense minus closing inventory. Here in this question direct expenses is not given, so opening and closing inventory information is here and purchase. So here the information is purchase is given 3,20,000, purchase is given. Okay, purchase is given, and one information, excess of closing inventory over opening inventory is 40,000. Excess of closing over opening is 40,000. Okay, 40,000 is that. So closing inventory is more than on opening inventory by 40,000. Okay, so this is not given, but yes, information regarding this is given. So you can write it this way also. So opening inventory minus closing inventory plus purchase. Yes, plus purchase. So this has given that after comparison it is 40,000. After comparison it is 40,000. It is minus 40. It is minus 40,000. Closing is more than opening inventory. Closing is more than opening inventory. And purchase is how much? Purchase information is 3,20,000 is the purchase. So it is 2,80,000 is the cost of revenue from operation. Cost of revenue from operation is 2,80,000. So you write the cost of revenue from operation over here, cost of revenue from operation, and difference is 1,20,000 is the gross profit. Gross profit is 1,20,000. Now you write the gross profit over here 1,20,000 into 100. So cancel the 40, okay, this 3, it means it's 30%. Gross profit ratio is 30%. Is it clear? Gross profit ratio is 30%. Now see one more question related to gross profit ratio. So question is, gross profit of a company is 25% of cost of revenue from operation. This information has given gross profit 25% of cost of revenue, not the revenue from operation. It is cost of revenue, 25% of cost of revenue. Its credit revenue from operations are twice, just double its cash revenue from operation. So credit revenue is double than cash revenue from operation. If the credit revenue operation is 4 lakhs, credit revenue from operation is credit revenue from operation is 4 lakhs. Okay. And one information which is given very important, its credit revenue from operation are twice its cash revenue from operation. So what will be the cash revenue from operation? Cash revenue from operation. Credit revenue from operation is twice. It means it is half, 2 lakhs. Cash revenue from operation is 2 lakhs. Then it is twice, means it is 4 lakhs. This has given. And information regarding the cash revenue from operation is given that the credit revenue from operation is just double than the cash revenue from operation. It means cash revenue from operation is 2 lakhs. So total revenue from operation, total revenue, both cash and credit revenue from operation is how much? It is 6 lakhs. Okay, it is 6 lakhs. So revenue from operation we have find out it is 6 lakhs. Okay. Another information has given that gross profit ratio 25% of cost of revenue from operation. Suppose cost of revenue from operation is 100. Cost of revenue from operation, let it be 100. So gross profit is 25% of cost of revenue from operation. 25% of cost of revenue from operation, it is 25. So cost of revenue from operation plus GP, when you add it plus GP, so this is what? This is revenue from operation. This is called revenue from operation. So when the revenue from operation is 100, then cost is how much? This. Or you can directly do the relation with this. When the revenue from operation is this, gross profit is how much? It is 25. So gross profit, you can write it, gross profit is equal to, when the revenue from operation is 125, GP is 25, when revenue from operation is 1, GP is 25 upon 100, and when the revenue from operation is 6 lakhs, then it will be 25 upon 100 into 6 lakhs. Yes, so you can write it, gross profit ratio is equal to 25 upon, sorry, this is 125. When the revenue from operation is 125, gross profit is this. When it is 125 by 25 by 125, when the revenue from operation is 6 lakhs, then it will be 25 upon 125 into 6 lakhs. Gross profit ratio. So it is 1 by 5 means 1,20,000. So write 1,20,000. Gross profit is 1,20,000 into 100 into 100. Cancel the 30. This one, and it is 2. So it is 20%. Gross profit ratio is 20%. 20%. So somewhere we will assume as 100. Here we will assume the cost of revenue from operation, suppose it is 100, then GP is 25% of cost of revenue. So GP is 25. So cost plus GP indicate your indicate your sales, indicate your revenue from operation. So when it is 125, then GP is how much? GP is 25, and we have already the information about the revenue from operation. So when the revenue from operation is 125, GP is 25. So when it is 1, then it is 25 upon 125, and when it is 6 lakhs, then 25 upon 125 into 6 lakhs. So I have calculated the GP ratio on the basis of that. Gross profit on the basis of that, then that gross profit I put up over here to find out the GP ratio. Now see the next question of gross profit ratio. From following information is available for the year ending 31st March 2020. Calculate GP ratio. So write the GP ratio formula. Gross profit ratio is equal to gross profit upon revenue from operation into 100. Cash revenue from operation is given, means cash sales is given. Purchase, both cash purchase and credit purchase is given. Carriage inward, that is the direct expense. Salary is the indirect expense. Decrease in inventory means opening inventory and closing inventory. When we compare it, it means closing inventory is less than the opening inventory. Then we say that it is a decrease in inventory. So return outward means purchase return is given, wages is given, wages is the direct expense. So first of all, and last one is ratio of cash revenue from operation and credit revenue from operation is 1:4. Cash revenue from operation and credit revenue from operation is 1:4. So on the basis of that, first of all, we will calculate the total revenue from operation, total revenue from operation. Total revenue from operation is equal to cash revenue, which is given in the question, cash revenue from operation, cash revenue from operation plus credit revenue from operation plus credit revenue from operation. So we have to add the cash revenue from operation and credit revenue from operation. Cash revenue from operation is 2 lakhs and credit revenue from operation will be 2 lakhs into 4 upon 1, because ratio between them is 1:4. 1:4. So it is 4 by 1. So cash revenue is 2 lakhs, then it is 8 lakhs. It is 1:4. It means revenue from operation is 10 lakhs. So revenue from operation we have find out, it is 10 lakhs. Okay, into 100 we will do it. Now next we have to find out the gross profit ratio. For gross profit ratio we will calculate cost of revenue from operation first. Cost of revenue from operation. So we know that the cost of revenue from operation, opening inventory plus net purchase plus direct expense. In direct expense it has given carriage inward is the direct expense. Carriage inward is the direct expense, one direct expenses, plus another direct expense is the wages which is given. Salary is not direct expense, salary is indirect expense. So wages, carriage inward minus closing inventory. Okay, so here opening inventory and closing inventory directly it is not given, but the difference of these two have given. Difference is what? Decrease in inventory. Closing inventory decrease as compared to opening inventory by 80,000. Decrease in inventory is 80,000. So opening inventory is more than closing inventory. So as compared to opening and closing inventory, opening inventory is more. So directly you can write 80,000, that is the difference in inventory. And net purchase is what? Net purchase, your cash purchase plus credit purchase is given. Cash purchase is this much and credit purchase is 4,50,000 is the credit purchase. So it is total purchase minus purchase return, that is return outward. Return outward is 20,000. This is return outward. Plus wages. Wages is given 50,000 plus carriage inward. Carriage inward is 6,000 is the carriage inward. Carriage inward is 6,000. First we will write the carriage inward plus wages is 50,000. Okay. Now 80,000. This is the change in inventory. 80,000 is what? Change in inventory. Opening inventory minus closing inventory. So here it has written that the decrease in inventory as compared to opening closing has decreased. It means opening inventory is more. So opening inventory and closing inventory difference is 80,000. It is plus. This is what? This is your net purchase. Cash purchase plus credit purchase minus purchase return. This is for carriage inward. This is for wages. So 80,000 plus you add it, it is 6 lakhs minus 20, so it is 5,80,000 is the net purchase, plus it is total is 56. It is 56. So now you do the total. 5,80,000 plus 80 plus 56, so it is 6,16,000. 7,16,000. Sorry, 7,16,000. 7,16,000. So cost of revenue is this much. So GP is equal to cost revenue from operation. Revenue from operation minus cost of revenue. Cost of revenue from operation. Okay, GP is equal to what? Cost revenue from operation, that is the net revenue, net sales, minus cost of revenue from operation. So revenue from operation is 10 lakhs and cost of revenue from operation is 7,16,000. 7,16,000. So GP is 2,84,000 is the GP. 2,84,000 is GP. It is 2,84,000 and your revenue from operation is 10 lakhs. It is 10 lakhs. Revenue from operation is 10 lakhs. So you calculate the percentage. So it is 28.4%. GP is 28.4%. Okay. So here we have to find out the gross profit ratio, revenue from operation, that is 10 lakhs, and cost of revenue is 7 lakh 16. So revenue from operation minus cost of revenue. So GP is 2 lakh 84. So write the GP and revenue from operation is 10 lakhs. So it is 28.4%. Now come to the next question. Opening inventory 60,000, closing inventory 1 lakh, inventory turnover ratio 8 times, selling price 25% above cost, calculate gross profit ratio. So here to calculate the gross profit ratio, no information is directly given regarding the gross profit and revenue from operation, then we will find it out from the available information. So here inventory turnover ratio is given. So you write the inventory turnover ratio formula. Inventory turnover ratio. You know the formula of inventory turnover ratio. Cost of revenue from operation. Cost of revenue from operation upon average inventory. Yes, this is the formula of inventory turnover ratio. So inventory turnover ratio is given, it is 8 times, is equal to cost of revenue from operation is not given in the question. Cost of revenue from operation is not given. Okay, we have to find it out. Upon average inventory is given, opening inventory plus closing inventory. Opening inventory is 60, closing inventory is 1 lakh upon 2. So 8 is equal to cost of revenue from operation upon 1 lakh 60 upon 2, 80,000. 1 lakh 60 upon 2 divided by 2. So 1 lakh 60 divided by 2, it is 80,000. So cross multiplication. So cost of revenue from operation is equal to 8 into 80,000. So it is 6,40,000. 6,40,000 is the cost of revenue from operation. Here one more information is given regarding the selling price. Selling price is 25% above cost. Suppose cost is 100, then profit is GP is 25%, means 25 rupees. So 125 is your sales, that is cost of revenue. Okay, so when the cost of revenue is 100, selling price is how much? It is 125. So we can find it out. The sales is equal to, means revenue from operation 6,40,000 is the cost of revenue. When the cost of revenue is 100, selling price is 125. On the basis of this, when the cost of revenue is 100, selling price is 125. So when it is 1, then it is 125 by 100. And when the cost of revenue is 6,40,000, then what will do? Multiply to 6,40,000. So I'm going to directly write over here 125 upon 100 will be your revenue from operation. So it is 54. So it is 8 lakhs. 8 lakhs is your revenue from operation is 8 lakhs. Revenue from operation is 8 lakhs. Okay. Now GP is equal to what? Gross profit is equal to revenue from operation 8 lakh minus cost of revenue. Cost of revenue is how much? 6 lakhs 40,000. Cost of revenue. Indicate your GP, revenue from operation minus cost of revenue. So it is 1 lakh 60 upon 8 lakhs into 100. So 40 cancelled, 00, it is 2. So it is 20%. GP is 20%. Okay, GP is how much? It is 20%. It's revenue from operation minus cost of revenue. So that is called GP. That difference will indicate your GP. Now coming to the next ratio in the profitability ratio. Next ratio after gross profit ratio is our, after gross profit ratio, next ratio is operating ratio. Operating ratio means cost of goods sold plus operating expenses upon revenue from operation into 100. Okay, you can say cost of goods sold plus operating expenses is known as operating cost. So formula will be operating ratio, operating cost upon revenue from operation. Revenue means net revenue from operation. Net revenue from operation into 100. Operating cost means cost of operating cost means cost of revenue from operation plus operating expenses. So operating cost is equal to cost of revenue from operation plus operating expenses. So cost of revenue plus operating expenses. Now what is operating expense? Operating expense means office and administrative and selling and distribution expenses come under operating expenses. So operating expenses means office and administrative plus selling and distribution expenses. This ratio shows that how much percentage of revenue cover with the operating expenses. As much as it is low, it is better, and as much as it is high, it is not good for the company. So this ratio should be low, less. So question is, from the following information calculate operating ratio. Informations are revenue from operation. Okay, so put the formula of this operating cost revenue ratio, put the formula operating ratio is equal to operating cost upon revenue from operation into 100. Okay, now see one question based on operating ratio. So question is, from the following information calculate operating ratio. Revenue from operation is 6 lakhs 80. Rate of GP on cost is 25%. Rate of GP on cost is 25%. Selling expenses 1 lakh 44. Administrative expenses 73. So write the formula of operating ratio. Operating cost upon revenue from operation. Revenue from operation is given in this question, that is 6 lakhs 80,000 is the revenue from operation. Okay, revenue from operation. We have to find out the operating cost. Here one information is related to GP ratio. GP on cost is 25%. Suppose cost is 100, then GP is how much? 25% on cost, 25. So GP plus cost indicate what? It indicates sales. So when the sales is this much, GP is how much? 25 rupees. Or you can compare with the, when the sales is this, cost of goods sold is, cost is 100. So cost of revenue from operation is equal to, we have the information of sales. When the sales is 125, cost is 100. When the sales is 6,80,000, cost of revenue will be 100 upon 125 into 6,80,000. It is 5,44,000. 5,44,000. Is it clear? 5,44,000 is the cost of revenue from operation. Okay. So operating cost is equal to, you can write it, operating cost is equal to cost of revenue from operation plus administrative expenses is given, administrative and selling and distribution expenses. So administrative expenses plus selling and distribution expenses, selling expenses. So cost of revenue is 5,44,000. Administrative expense given in the question is 73,000 and selling expenses is 1,44,000. So 5,44,000 plus 73 plus 1,44,000. Okay, plus 1,44,000. So total is 7,61,000. 7,61,000. Yes, 7,61,000. It is 7 lakh 54, 1,44,000, 73, 7,61,000. 7,61,000. Okay, which is more than the revenue from operation, okay, which is more than. So you deducted 7,61,000 upon 6,80,000 into 100. So it is 111.91%. It's not a good thing for the company that the operating cost is higher than revenue from operation. It should be less and as low as possible, but it is higher. It means company is going to suffer a loss, major loss in future. Okay, company is going to suffer a loss. So it is 111.91% is the operating ratio. Now see the next question. Calculate operating ratio from the following information. Net revenue from operation is given. Net revenue from operation means what? Credit revenue from operation plus cash revenue from operation minus sales return. Second information is cash revenue from operation is given, gross profit ratio 20%, office and administrative expenses, office and selling expenses, this is operating expense, depreciation is also operating expense, loss on sale of plant is non-operating expenses or losses, it is non-operating loss. So when we are going to calculate the operating ratio, write the operating ratio formula, operating cost by net revenue from operation. So first of all we will calculate the revenue from operation, net revenue from operation. It is given, net revenue from operation is given, that is 8 lakhs. It is given in the question, 8 lakhs is the net revenue from operation. It is given in the question into 100. We will find out the operating cost. Okay, operating cost means here operating cost is equal to cost of revenue from operation, cost of revenue from operation plus operating expenses, cost of revenue from operation plus operating expenses. Operating expenses is office and selling expenses. So operating cost is equal to cost of revenue from operation plus operating expenses, and in the operating expenses office and selling expenses is given, selling expenses plus one more, that is depreciation is given, depreciation is operating expenses, and loss on sale of plant is non-operating loss. This will not be taken into account while calculating the operating cost. So operating cost of revenue from operation plus office and selling plus depreciation. Now come to the cost of revenue from operation. First of all we will calculate cost of revenue from operation. This is not directly given in the question, but there is a clue is given, that is the gross profit ratio is given, gross profit ratio, that is 20%. 20% on what? 20% on sales. So if the sales is revenue from operation, this is given revenue from operation minus gross profit, this will indicate the cost of revenue from operation. Revenue from operation is 8 lakh minus GP is 20% of, GP is 20%. 20% of what? 20% of revenue from operation. So 8 lakh minus, it is 1,60,000. So it is 6,40,000. Okay, so you write it, cost of revenue from operation 6,40,000 plus office and administrative expense. Office and administrative expense is 60,000 plus depreciation is 20,000. So it is 7,20,000. 7,20,000. Okay, so 7,20,000 is the operating cost. So we'll calculate the operating ratio. It is %90. It is 90%. Okay, it is 90%. 90 operating ratio is 90% as compared to revenue from operation. From the revenue from operation, operating cost is 90%. It is too high even. It should be low. Then the company can bear the other non-operating expenses and losses. Then company will get the net profit, earn some net profit. Now come to the operating profit ratio. Operating profit ratio is equal to operating profit upon revenue from operation into 100. So operating profit, we will calculate the operating profit. Operating profit is equal to gross profit minus operating expenses plus operating income. Okay, gross profit minus operating expenses plus operating incomes. Okay. So we'll calculate the operating profit ratio. Third formula is operating profit ratio. Third ratio, operating profit upon net revenue from operation. Now see the question. Calculate operating profit ratio from the following information. Revenue from operation 8 lakhs, that is net sales. Gross profit 25% on cost is given. Selling and administrative expense 20,000. Selling expenses 28. Office and administrative 20. Selling expense 28. Loss by fire. Loss by fire is non-operating expenses. So this will not be taken into account or consider while calculating the operating profit. So operating profit ratio, operating profit upon net revenue from operation. Net revenue from operation is given, that is 8 lakhs. It has given 8 lakhs is the net revenue from operation. Operating profit is not given in the question, so we'll calculate the operating profit first. So GP ratio is, gross profit ratio is 25% on cost. Suppose cost is 100, it means GP is 25% on cost. So it is 125 is sales, that is revenue. So when the revenue is 125, our GP is how much? 25. So you can write it, GP is equal to, gross profit is equal to 25 upon 125 into sales is 8 lakhs. Revenue from operation is 8 lakhs. So 1 by 5, it is 1,60,000 is the GP. So write the GP over here, GP is 1,60,000. Now we'll find out the operating ratio. So GP is 1,60,000. So operating profit is equal to, operating profit is equal to gross profit minus operating expenses. So operating expenses is office and administrative expenses minus another operating expense is selling expense, is the operating expense, selling expenses. Okay, selling expenses. So GP is 1,60,000 and operating expense, under the operating expenses, two expenses are there, office and administrative and selling expenses. Office and administration is 20 and selling is 28 and selling expenses is 28,000. So we'll deduct 48 from here. So 1,12,000 is the operating profit. Operating profit is 1,12,000. Operating profit 1,12,000. So 20 cancel, 30. So 14% is operating profit. Operating profit upon net revenue from operation. Operating profit is GP, gross profit, minus operating expenses, and if the operating income is there, then we will add the operating income. But in this question, no operating income is there, so we'll deduct the operating expenses. Operating expenses, office and administrative, selling and distribution expense. So this is our operating profit. So you write the operating profit upon net sales into 100. It is 14%. Now see the next question related to operating profit. So the question is, calculate operating profit ratio from the following information. So question is cash revenue from operation, that is cash sales, net purchase, credit revenue from operation, carriage inward, finance cost, administrative expense, profit on sale of fixed assets, and discount received. So you write the formula first. Operating profit ratio is equal to operating profit upon net revenue from operation. So net revenue from operation, is equal to revenue from operation is equal to, here cash revenue from operation is given, cash revenue from operation, that is cash sales, plus credit revenue from operation is also given, credit sales, credit revenue from operation, so both is given, cash sales and credit sales. So cash sales is 1 lakh, cash revenue from operation and credit revenue from operation is 3 lakhs. There is no sales return, so this is your revenue from operation, 4 lakhs. So revenue from operation is 4 lakhs into 100. Okay, now we have to find out the operating profit. So operating profit, how to calculate the operating profit from the given information? Net purchase, carriage inward, these are what? From this we will calculate the gross profit first. Gross profit is equal to GP is equal to revenue from operation, upon minus cost of revenue from operations. Okay, we will get the gross profit. Revenue from operation is 4 lakhs. Now we'll calculate the cost of revenue from operation. So cost of revenue from operation, cost of revenue from operation is equal to, as per the information given in the question, net purchase is there, net purchase plus direct expenses, and in the direct expenses carriage inward is there, carriage inward is direct expense. Okay, carriage inward is direct expense. So net purchase is, in this question net purchase is 2,97,000 and carriage inward is 3,000. So it is 3 lakhs rupees is the cost of revenue from operation. So cost of revenue from operation is 3 lakhs. It means GP is 1 lakh, gross profit is 1 lakh. Here it is clear, gross profit is 1 lakh. Now operating profit is equal to, gross profit minus operating expenses. Operating expenses are, administrative expense is operating expense, number 1. Okay, operating expense is administrative expense. Finance cost is not operating expense, finance cost will not be taken into account, administrative expense. And non-operating income is your operating income is discount received is your operating income, you add it. So gross profit minus operating expenses plus operating income. So operating income is discount received. So gross profit is 3 lakh and administrative expense is 40,000 plus discount received is 7,000. Here the profit on sale of fixed assets is given. Profit on sale of fixed assets is non-operating income, so this will not be taken into account. Okay, so gross profit is how much? Gross profit is 1 lakh minus 40,000 plus this, So it is 67,000. 67,000 is your operating profit. So write the 67,000 over here. 67,000 is the operating profit. So cancel to this. 16.75%. Okay, 16.75. So operating profit is equal to gross profit minus operating expenses plus operating income. In operating expenses there is only one, administrative expenses. Your finance cost is not operating expenses, it is non-operating expense, finance cost. Discount received is operating income, but profit on sale of fixed assets is non-operating income. So profit on sale of fixed assets will not be taken into account or considered while calculating the operating profit. Yes, of course, the finance cost and this profit on sale of assets will be taken into account when we are going to calculate the net profit. Okay. Now under the profitability ratio, the fourth one is net profit ratio. We have discussed gross profit ratio, operating profit ratio. Now net profit ratio. Net profit ratio is equal to net profit upon net sales into 100. Net profit means how to calculate the net profit? Gross profit minus all expenses plus all incomes, revenue incomes is your net profit. So net profit after tax will be taken into account. So net profit ratio is equal to net profit after tax upon revenue from operation. Revenue from operation means net sales into 100. So see one question. Gross profit ratio of a company is 20%. Its credit revenue from operation is 18 lakhs. Cash revenue from operation were 10% of total revenue. Suppose total revenue as per the information given, total revenue is 100. Okay, it means as per this information, cash revenue from operation were 10% of total revenue. So cash revenue from operation will be 10 rupees. So total revenue minus cash revenue, this indicate the credit revenue. This indicate what? Credit revenue. So when the credit revenue is given, in the question credit revenue is given, then you can calculate the total revenue. So total revenue is equal to when credit revenue is 10, total revenue is 100, and when the credit revenue which is given in the question is 18 lakhs is the credit revenue, then total revenue will be how much? Okay, so it is 20 lakhs is the total revenue. So 20 lakhs is the total revenue from operation. Total revenue from operation is 20 lakhs. Now we will calculate the net profit from this information. So if the indirect expense were 50,000, calculate its net profit ratio. Gross profit ratio is 20%. So GP is, as per the information, GP ratio is given. GP ratio is how much? 20%. So it means gross profit is 20% of total revenue. So how much it is? 4 lakhs is the gross profit. Okay. So operating profit is equal to net profit is equal to gross profit minus all expenses, whether it's operating or non-operating, all revenue, expenses and losses plus all revenue, incomes and gains, not indirect incomes, you add it. So here indirect expenses is 50,000. So indirect expense, you deduct the indirect expenses from the gross profit. Is there any indirect income? There is no indirect income. So gross profit is 4 lakhs minus indirect expenses 50,000. So GP is how much? GP is 3,50,000. Sorry, net profit is 3,50,000 is the net profit. So write it net profit over here 3,50,000. So it is 17.50%. 17.50%. Okay. 17.50%. Tax information is not given in the question. So this is the net profit before tax is taken into account. Now see the another question related to net profit ratio. Calculate net profit ratio from the following information. Revenue from operation is given, that is sales. This has given revenue from operation is given in the question, that is 20 lakhs. Revenue from operation is 20 lakhs. This is given. Okay. Now next information is gross profit ratio is 30%. Operating ratio if it is 80% means operating cost is 80%. So 20% is what? 20% is your operating profit. So we can calculate the operating profit easily. Operating profit, it means operating profit, if operating ratio is 80%, then 80 minus 20, if the operating ratio is 80 means operating cost is 80. So out of 100 we deduct it, so this 20 indicate the operating profit. This is operating profit. So operating profit, it means operating profit is 20%. 20% of what? 20% of revenue from operation. So operating profit is 4 lakhs is the operating profit. So net profit is equal to operating profit minus non-operating expenses plus non-operating income, minus non-operating expense and add non-operating income. So here non-operating expenses is given. Non-operating expenses, operating expenses will be deducted plus non-operating income will be added. Non-operating income we will add it to find out the net profit. So operating profit is 4 lakhs minus non-operating expenses, non-operating expense 30,000 and non-operating income is 50,000. So it is 4,20,000. 4,20,000 is our net profit. 4,20,000 is our net profit. So write the net profit over here, 4,20,000. So it is 21%. 21%. Is it clear? So operating profit, you can easily calculate. If operating ratio is 80%, means 80% is the operating cost. It means rest 20% is the operating profit. So directly you calculate 20% operating profit on revenue from operations, that is 4 lakhs. Now next ratio is return on investment. So return on investment is equal to net profit before interest, tax and preference dividend upon capital employed. So last ratio in our syllabus related to profitability ratio is return on investment. Return on investment is equal to net profit before interest, tax and preference dividend upon capital employed. If you want to know the capital employed, you know it. Capital employed means owner's capital plus borrowed capital both. So formula will be shareholders fund plus non-current liability. Non-current liability means long-term borrowings plus long-term provision. In Other way also we will calculate there is another way to calculate the capital employed, non-current assets from the asset side, non-current assets plus current assets minus current liability means working capital, non-current assets plus working capital. If you add it, working capital in the non-current assets, the rest part will indicate the shareholders fund and non-current liability, a non-current liability. So the question is based on, we'll see the question based on this. From the following, calculate the return on investments. Share capital is given, reserve and surplus is given, net fixed assets, non-current trade investment, current assets, 12%, long-term borrowing and current liability. So first of all, we'll calculate the capital employed. For capital employed, here in this question, for calculating the capital employed is equal to, as per the information given in this question, capital employed is equal to, in shareholders fund it is given share capital. Okay, we'll take the share capital plus reserve and surplus, reserve and surplus. This is shareholders fund plus in non-current liability there is a 12% long-term borrowing, 12% long-term borrowings will be taken into account, 12% long-term borrowing. So share capital is 50,000, reserve and surplus is 25,000 and long-term borrowings is 2 lakhs, 12%. So it is 2,75,000. 2,75,000 is our capital employed. 2,75,000 into 100. Now we will find out the net profit before tax and preference dividend. So here the net profit is given over here. Net profit before tax is given in the question at the bottom. It is 60,000, but it is before tax. So we'll add the interest because we want net profit before interest, tax and dividend. So interest we have to add it, interest on long-term borrowings. Long-term borrowings will be added. Interest on long-term borrowings we will add it. Borrowing is 2 lakhs and rate of interest on borrowings is 12%. So it is 24,000. So when we add it, this 84 is net profit before interest and tax. So net profit before interest and tax is 84,000 upon this into 100. So 84,000 upon 2,75,000 upon 100. Okay. Now it is, this percentage is 30.55%. If you calculate it, 30.55%. Now come to the next question related to return on investment. Net profit after interest and tax is given. Net profit after interest and tax is given in this question. That is, net profit after interest and tax is this, and we want net profit before interest and tax. Okay, tax rate is 20%. Tax rate is 20% is the tax rate. So first of all, we add the tax. We add the tax. Tax rate is how much? 20%. Suppose net profit before tax is 100, then tax is 20. So it means net profit after tax is how much? 80. So when the net profit after tax is 80, tax is 20. So this is net profit after tax. So 1 lakh into 20 upon 80. When net profit after tax is 80, tax is 20. When net profit after tax is 1 lakh, so tax is how much? Tax is 25,000. So we add the tax. So this is what? This is net profit before tax. Before tax. But after interest. So we'll add the interest. Interest is how much? The 10% long term debts. 10% long term debts. Long term debts is 4 lakhs. And interest rate is 10%. So it is 40,000. So it is 1,65,000. 1,65,000. So 1,65,000 is net profit before interest and tax. And now to the capital employed. Capital employed is equal to, as per this information, current assets is given, current liability is given, fixed assets is given. So from that side we will calculate capital employed is equal to non-current assets. Non-current assets means fixed assets is given, fixed assets plus working capital. So fixed assets, non-current assets given in the question is, non-current assets is 6 lakhs. Fixed assets is 6 lakhs plus working capital, current assets minus current liability. Current assets is 4 lakh and current liability is 2 lakhs. So net difference indicate the working capital, current assets minus current liability. Okay, current assets minus current liability. So here 6 lakhs plus 2 lakhs is our working capital. So 8 lakh is our capital employed. Capital employed is 8 lakh. Now 1,65,000 upon 8 lakh into 100. 8 lakh into 100. So if you divide it, 20.63%. 20.63%. So ROI is 20.63%. Now see the next question based on ROI, return on investment. Here the capital is given, equity and preference both, general reserve, 10% debenture, current liability, net profit after debenture interest and income tax. So first of all, we'll find out net profit, which is given here, net profit after interest and tax is given, debenture interest and tax, that is 80,000. So we will add the tax first, because we have to calculate net profit before interest, tax and dividend. So tax rate is 50%. Okay, tax rate is how much? 50%. Suppose net profit before tax is 100, then tax is, as per that, 50% tax, it is 50. So net profit after tax is, net profit after tax is 50 rupees. So net profit after tax is 50, then tax is how much? 50 rupees. Okay, so tax is here 50 upon 50 into net profit after tax is 80,000, so it is 80,000. So net profit before tax is, net profit before tax, okay, but after interest, interest is 1,60,000. Now what we'll do, we'll add the interest on debenture, so debenture is 4 lakhs into rate of interest is 10%, so 40,000. So net profit before interest and tax is, net profit before interest and tax is 2 lakhs. So write the 2 lakhs over here, net profit before interest and tax. Now coming to the capital employed. For capital employed, equity capital employed is equal to capital employed shareholders fund plus borrowed, long term borrowed. So here the share capital, equity share capital plus preference share capital, equity share capital plus preference share capital plus general reserve plus 10% debenture. This is the borrowed capital, 10% debenture plus 10% debenture plus profit and loss. So here it is, if you see the calculations, so share capital is 4 lakhs, preference is 1 lakh, general reserve is 2 lakhs 70, 10% debenture given is 4 lakhs, 10% debenture 4 lakhs plus net profit after interest and tax 80,000. So it is, total is 4 lakhs plus 1 lakh, 5 lakhs, 6, 7, 11, 12 lakh 50,000. 12 lakh 50,000 is the capital employed. So 12 lakh 50 into 100 into 100. Okay, so this is 16%. This is 16%. Now see the next question. A company has a loan of rupees 20 lakhs as a part of its capital employed. Loan component is 20 lakhs as a part of capital employed. The interest payable on loan is 15%. ROI of the company is 25%. ROI means return on investment is 25%. The rate of tax is 40%. What is the gain to the shareholder due to loan raised by a company? Company has raised a loan of rupees 20 lakhs. So as per the ROI, return on investment, profit before interest and tax from the loan component is 20 lakhs is the loan components, and if this amount, on this amount company will get the return at the rate of 25%. ROI is 25%. ROI is 25% return on investment. So it is 5 lakhs. 5 lakhs. Okay, it's 5 lakhs profit before interest and tax. So deduct the tax less, first you deduct the interest on loan. So 20,000 is the loan component and interest rate on this loan is 15%. So it is 3 lakhs. So deduct it, 2 lakhs is after interest. Net profit after interest, because of this loan component, less tax. Tax is how much? Tax is 40% is the tax component, 40%. So 40% of this is 20,000. 40% of 2 lakhs. So it is 80,000. So 1,20,000 is the return after all these things, after all. So net gain to shareholders is, net gain to shareholder is 1,20,000. 1,20,000. If the company take the loan of rupees 20 lakhs and ROI 25% or interest rate is 15% and tax rate is 40%, then the shareholder will be benefited from that loan 1,20,000, benefited by 1,20,000. This will be the answer.